Hi, I'm Peter Rose, founder of Longwood Currency Trading. I was going to talk today about Forex trading using your past experiences. I think there can be some good aspects to past experience and bad aspects, and I think it's important that we take a look at that in order to enhance your abilities at dealing with the Forex market using what you're already good at and getting away from what you're already bad. But before I do that, it's such a beautiful day. I got to get a cup of coffee. We'll go out onto the porch and we'll talk out there. But first, a little coffee. Boom. Boom. It starts. All right, let's get this going. Can't beat the day. All right, coffee in hand. Past experiences in your Forex trading. Let me tell you a story about a bad past experience that I have that was good while it was happening, that has negatively affected my Forex trading. Because I think looking at the bad stuff is far more dramatic and indicative of why you need to look at your past experience and how you can bring that experience to positive bear in fruition in your Forex trading. Okay, so if you've followed me in my Forex journey so far, you know that I was in real estate investment for 40 years. And I made $1 million. Okay, so actually I had to make $1 million a couple of times because I've lost $1 million twice in my life due to economic collapse, right down to bare bones. $1 million net worth loss. I still retain my assets because I knew the rules of the game, but $1 million is $1 million no matter how you shake it. I was able to make that $1 million back each time, but it took me 10 years. So I sort of understand the real estate environment and say, well, you know, I made $1 million, so what? People make zillions of dollars. Well, yeah, but I retired and I was able to buy this house for cash before I sold my other house because I've got enough money that I can do that. I have some flexibility there. So it's not how much money that you make or have, it's how you use it and how that affects your life. If all you're doing is making money, then where comes the point where you enjoy just sitting out on the porch like this and enjoying life? Well, maybe you don't live in a very nice neighborhood or a very nice environment. You make the environment based on what you want it to be, not what it is. That's how you get successful. You don't know how to trade, and so you learn the rules and you take the losses and you put things together, and eventually you learn what to do because you've done enough of the what not to do's that you learn what to do, and then you become successful. You have a vision of why you're sitting down at the desk to trade currencies or to invest in real estate or have a 9-to-5 or whatever it is that you're doing. In any event, I know what I'm doing in real estate. One of the things that you do in real estate is you buy it and you hold it. You don't flip it. And there are a lot of reasons why many of the people who do flips eventually get caught and they flatline. I'm not going to go into that now. But you don't buy a piece of real estate, an investment piece of real estate, or even your home, to flip that out in 3 weeks or 3 months or whatever. You buy it for 5 years or however long the job's going to last you in that particular town, and then you move on to the next. So you're holding real estate, residential stuff for 5 to 7 years before you move to the next place. We were just out to dinner last night with friends, and they've been in the same house for oh my gosh, 40 years, I guess. You know, it's just how you view the situation you're in as to how long you're going to stay in a piece of real estate. But from an investment real estate standpoint, you buy it to hold it, because the compounding in the long run overcomes your expenses of repairs and lost rental income and all that other sort of stuff that goes part and parcel with being in investment real estate. Holding it. And when the rough weather comes, you don't get out, you hold it because you followed certain rules that enable you to weather those storms. Not being highly leveraged is one of the rules. Making sure that the repairs that need to be done are done on a shiny day and not when there's a hole in the roof or whatever. Apportioning a certain percentage of your monthly rental income toward future expense. Those are all rules to put things together. And if you do those over a long time frame, the results are stunning. You know, I bought a building, this is a long time ago, for I think it was $73,000, a 4-unit apartment building, and sold it, I don't know, 30 years later, 35 years later for, I think it was $600,000. It was about $600,000. That was a pretty good return on that $73,000. Now, obviously, there were expenses and stuff, but because I didn't have any mortgage at the time, I was holding a check for $600,000. So that is ingrained in me to do my analysis of an asset up front and make sure it's something that I want to own forever. It's very Warren Buffett style applied to real estate that say he applies to his craft of identifying stocks. So I come into the currency market and I look at FOREX and I determine that's probably not a market you want to be a long-term investor in. There are a lot of reasons for that. This video isn't about that, but I saw the power and the potential of being a day trader because of the volatility in these markets and the uncertainty, the massive complexity of these markets. It's far better to close out at the end of the day and pick it up again fresh the next day. If you're trading down on a 5-minute chart, you have 12 periods an hour, or you could make a decision either to get in or manage to trade in some way or to exit. So there's plenty of opportunity to trade. The problem that I've run into understanding the viability, the security that I feel, the safeness of trading on a day trading basis where I'm flat at the end of the day. I mean, when I follow my rules, I make a lot of money. And I've always said when I don't follow those rules, I end up losing tens of thousands of dollars. And I shouldn't. I should lose $2,000. But I lose tens of thousands of dollars. Why is that? It comes down to the real estate. You don't abandon your asset that you worked hard in order to do the analysis on to say this is something of value and it's going to get more valuable because of these 5 characteristics or whatever it is. This is the cash flow. This is what I can hit at the end if I hold on to it. Does it cash flow during the period that I have on a positive basis so that the property carries itself and lets that compounding add in? That's the mindset that I have. It's part of my DNA. If I'm making a trade, and this is my problem, so if I'm doing a trade, say I'm trading a 3 lot or a 5 lot or something, and it starts to go bad against me. Let's say I put a 10 pip stop on a 3 lot position. That's $300 that I get stopped out at. I don't have any problem with that. If I put a 5 lot on, it's $500. I don't have any problem with that because I know what my trading metrics are, and I know that whether those metrics are 60-40, 70-30, or 75-25, it really doesn't matter. I know what my average win value is. I know I can lock that 10 pip stop in. And so over 100 trades or even 50 trades or whatever, I'm going to come out really well ahead. So it doesn't bother me to get out of that trade. And so when I have a position that I've put on, and you know, if I'm trading 3 to 5 lots, I'm all in, all out. I go in with 3. If I don't like it, I come out with 3. If I go in with 5 and it goes to my profit target, I'm out with 5. I'm not pulling off pieces of it, and I'm not adding pieces onto it. But when I get up into the point where I'm trading a 6-figure account and I'm trading 10, 20 lot positions, you don't want to go in with 10 or 20 lots right up front, because the 10 pip stop is $2,000. You have to understand how to work your way into those things. When you have the larger lot size capable bank, you can go in with 3 lots and then add to that. Maybe you'll add another 3, or maybe you go in with 5 and add 3, and so pretty soon you've got, let's say, 8 lots. If you go in with 5 and it goes against you, I get out. It goes in my favor, 5 lots, then I add another 3. Now I'm 8 lots. That's $80 a pip. Now we're starting to have some juice. It goes a little bit further. I go 3 more in. I'm 11, maybe 12 lots. And all of a sudden it spins around. I get caught in somebody releases some major news event that has to do with interest rate issues. You know, it might be a minor economic news release, and you know as well as I do, that price can run 40 pips in a couple of minutes. And so there I am with my 12 lot position, and as I'm building those positions, sometimes I'm getting out and getting in and whatever. So I'm not using a stop as opposed to that initial stop that I have. Stop is because I haven't built my position yet, so I don't want to get distracted, because I'm only going to be there for an hour or 2 hours. But then all of a sudden you get this spike. It goes 40 against me, and maybe I haven't got my stop on there. Banks don't put stops on. They don't use stamp. When you're trading larger lot size positions, you don't use stops because you're there to manage that trade. But as that trade moves against me, my real estate DNA kicks in and goes, we have to manage this trade. It's going to be okay. In the long run, you'll be okay. And all of a sudden, I'm $7,000 out, and I'm going, what just happened? Well, $7,000 is a shithouse full of money. Well, I didn't get into that trade to get out of it right away with a $50 gain. I'm not going in with 12 full lots at $120 a pip to make 2 pips, right? I'm looking for 8, 10 pips, 12. And now it's 40 against me because of whatever. Or maybe I just got stupid and let it compound out against me. The fact is that there I am, $5,000, $6,000, $7,000 out, and I'm going to manage the trade. I'm going to work my way around it. So now I'm been sitting there for 2 or 3 hours. Price is stopped and it's starting to flutter. Well, it's not going to go anywhere, so I'll do a carry on it. I wake up in the morning and boom, price has gone another 20 pips. So now I'm 50 pips out on a 12 lot. Terrific, terrific, just terrific. And that is not because I'm stupid, it's because my past experience, my strength in real estate is an impediment to my currency trading. It's part of my DNA though. So you can't just shake it off and say, well, this is a different market, because you don't do that. And I'm sure that if you look in your past experience, you're using either your education, your street smarts, your age, or whatever experience it is that you have. Maybe you've been a car salesman, and so you know the bartering type process, and you're establishing value of things by doing that. Or maybe you're a baseball card collector or a stamp collector, and so you learn to recognize value and how that value will expand over time given the right conditions that the thing is part of it. So you have all these experiences that you can bring to the table. Very rarely will I run into somebody who's asking me for information. Will they have had the DNA changing experience like a real estate buy and hold that I have? Because I've had that experience and I still suffer for it. And I mean, I lost 6 figures last year. This is 2024. Had a bad year. And because of that, because I held that position. And it overpowers you. You just think, well, how far can it go? How bad can it go? I've had real estate that I've owned that's gone down 40% and taken 200% of my down payment with it. At some point, you have faith in the real estate market. Not so much the real estate market, but they say location, location, location for real estate, yeah. So I always buy properties in good locations or properties that are unique. You know, you've all seen pictures of my house that I have here. It's a 1775 antique cape. Who owns a building from 1775? Well, even though it's old and it's creaky and it has its quirks and it's a farmhouse, it's desirable because of its historical value. Though it may fluctuate in price in real estate economic changes, where I think a normal, quote, property down in one of the other towns close to where we live, a larger town, maybe 30,000 people or something like that. We're just 2,600 people here in the town that I live in. Maybe those property values, those big houses, those condos that are going for $400,000 or $500,000, $600,000, maybe those will go down 30 or 40%. But I'm not real sure that because of the intrinsic value of the property that I have, that I bought because of that intrinsic value, that in turn is going to go down 30 or 40%. It may go down 10%. And that's okay. I have no mortgage, so it's okay. But I can't bring that same feeling of protection and safety into my currency trading when I let these positions run. It's interesting to me to watch things disintegrate, and for me to sit there going, I really shouldn't be doing this, but it's so inbred in me. Then you say, well, you should have rules to do that. I have rules to do that, but as I've said, when you're trading large lot size positions and you're doing that on a day trading basis, you don't run a stop behind you, because once you get a position going and you're still in the process of building that position, you expect that to come down 10, 15, or 20 pips and then cycle back up. The dance is between the average position value and where the current price is. And it's that dance as you build prices, it goes and fluctuates like this. And sometimes you're underwater and then you go up, and sometimes you're underwater. So being underwater doesn't mean that you close the position. It means that you manage the position. But all of a sudden you can get one of these spikes and go, and you're out, you're gone, because you'll be 30, like I said, 30 or 40 pips out on a 15 lot position. That's a lot of money. Do the math on that. A 15 lot, $150 a pip times 40 pips. That's a lot of money. And you sit there and you go, yeah, man. Well, the conditions and that's where the real estate thing for me comes into play. Well, the economic conditions shouldn't be this and blah, 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 and over the long run. but I don't have any control over those conditions or real psychic ability to say anything about the currency markets, whereas I would have that ability in the real estate market, because those long-term conditions are predictable if you pick the right real estate market to go into. They're not in the currency market. So that's my failing. But that makes me a better mentor for people, because who would you rather learn from? Somebody that hits it lucky at 500 to 1 and takes a $10,000 account to 6 figures, and then the 6 figures to a few $1 million, and they're riding around in a Lambo? Is that the person that you want teaching you just because they've made a lot of money? If you don't lose, you don't learn anything. So you better be talking to people that lose and are able to come back and value loss as part of the aspect of the trading. You have to understand, looking at your past experience, the good and the bad. So you look at your past experience, and you know that. Now you have to figure out what the currency market is. So you understand the landscape and the problems that you're going to face. What skills do you have that will enable you to deal with those problems correctly? And what skills do you have that will counteract that? You have to take that into consideration. I don't mean to get all touchy-feely with the psychology and all that stuff, but any good trader will tell you that far more than 50% of the skill in currency trading is know thyself, is the psychology of you, not the market. You have to understand that you are a microcosm of that market. So whatever twitty attitude that you have, all the other traders out there have that same twitty attitude. So you need to be able to be objective about that market. And if you have a past experience such as I have in real estate, you have to be hyper aware of that. And no matter how big that loss is when it initially comes out, you were wrong and you need to cut that. Even though it's a $5,000 loss, you need to cut it. Sometimes I catch it, but sometimes I just sit there and I go, or most of the time I sit with it on a carry trade overnight. I wake up in the morning and it's 2 or 3 times worse than it was when I went to bed. I should have just cut my loss and gone. But I don't, because of the real estate. So your Forex trading using your past experiences is a vital tool in your skills that you're trying to build in order to deal with the Forex market, with you as an individual within that market, and the trading methodologies and strategies that you're developing have to be in confluence with market characteristics and also with your characteristics as a person, with your psychological makeup and your character, in intermingling with these very complex markets in order to simplify things. I've simplified things. I only make one mistake, and that's I hold losing positions too long, and I know exactly why I do it. So the solution is very simple: just get out. That solution is not quite so easy. And so my work is not getting out. My work is in making sure that the trade that I take right initially is doing what I thought that it should do. And sometimes it's easy for me to forget that, because in real estate you don't worry about it. So just be aware of them. Use the good ones in a good way. Make sure that the bad ones you're aware of so that you cut those really quick when they start to affect your trading. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.